Is the United States going to be in a recession or a major slowdown by New Year's Eve this year?
It's very clear that we're losing momentum in the domestic economy. So whether or not we see the first negative print in 2019, that remains to be seen. But I do think that more generally, we are seeing an underlying loss of activity when it comes to housing, the consumer, business investment. So the key sectors of the economy are telling the Fed that they were very right to move to the sideline. And at this point, we need to think about moving from neutral policy to defensive policy as the risk of recession does rapidly rise, not only for 2019, but in particular when we look out to 2020.
Quick follow, Lindsey, the Fed meets on April 30th, the end of this month. Do they cut rates?
I don't think they cut rates that soon. I think the Fed is going to remain, as they said, on the sideline. They're going to remain patient for some time, particularly as they continue to draw down the balance sheet. Remember, they're not going to right-size that until September, is what they've told us as of late. But I do think the Fed is going to be increasingly focused on the data and prepared to give us that first rate cut. We have it officially priced in at the first quarter of next year. But if the data deteriorate at a faster pace than expected, we could easily see that moved up to the fourth quarter or even the third quarter of this year.
Jurrien, how much of this incredible stock run in 2019 has been the Fed getting dovish, or the fact that we simply overreacted and sold off without reason or rationale in December?
All of the above. I mean, the 20% decline that we briefly saw on December 26th probably should have been a 15% decline, but we had lack of liquidity, we had forced selling and momentum trades, et cetera. And so it probably was a little bit worse than it should have been, and the recovery, therefore, has been steeper than it probably would have been. But obviously, the Fed plays a huge role in that because the Fed did pivot. The Fed is basically done for the cycle, stopping just shy of sort of neutral, or if you think R-star is at around 2.5% nominal. And now the question, of course, is that the market is pricing in rate cuts. 2.5 rate cuts, actually, over the next year and a half or so. I don't think the Fed is in a hurry to cut rates. Obviously, they're paying attention. The bond market has put them on notice with the very brief inversion that we saw a week or so ago. But I think we're going to need more data points for the Fed to really keep going in terms of its pivot. And, you know, the street's looking for a V-shaped earnings recovery. I don't know if it's going to happen, but if that V turns into a U or an L, then probably we will see rate cuts. But if we do see the recovery that the street is looking for following Q1, which of course we're going to be reporting on pretty soon, then I don't see why the Fed would be cutting rates here, and maybe just pivoting to neutral will be enough for now.
About 1 minute left in show, Lindsey. The transportation index up 6 of 7 sessions, nearing new highs. Is it getting it wrong?
Well, I think we have seen some pockets of improvement. We've seen better numbers in terms of construction, in terms of manufacturing. But when we look at the underlying data, a lot of the recent improvement has been more on the inventory side. So you couple that with slower growth. And regardless of some of these ancillary indices, it's all about the consumer. And that's likely to translate into maybe a short-term improvement in some of the figures, but not a longer-term bump to stave off that weakness or the eventual recession that we do see lurking around the corner.